Last night, we published a reporting season wrap for the consumer discretionary sector, which we called Hello Sunshine, but it's intended to convey the new mood of optimism which appears to have descended upon the sector over the course of February. Sentiment was buoyed largely by pretty positive earnings performance across the consumer discretionary sector. Most companies did better than we expected, and they reported a further improvement in sales trajectories as they came into the first few weeks of the second half. And optimism was further enhanced by some early evidence that the consumer in Australia may be starting to defrost in terms of their confidence and their sentiment for the future. And that's a dynamic that's historically driven positive share price appreciation in the share prices of companies in this space. So you might have missed it in the deluge of results, because on the 13th of February, right in the middle of reporting season, we had the latest update on consumer sentiment out of Westpac Melbourne Institute, and it was pretty strong. It jumped by 6 percentage points, which is the highest monthly gain we've seen in consumer sentiment since April last year. And that's what's shown by the heavy blue line on the left-hand side here. That little uptick is relatively positive. But what's more positive is that there was an 11 percentage point surge in consumers who were saying, now is the time to buy a major household item. And that's important because this is the area that has been most subdued over the last couple of years as people have struggled with the cost of living pressures. And so the fact that people are starting to say, I'm getting ready to once again buy big ticket items is a very positive signal that perhaps the cost of living pressures may be starting to ease as CPI comes down, as you can see from the other blue line on that left-hand chart. So many of the conditions seem to be in place for a recovery in consumer sentiment. Unemployment, and that's really the kryptonite of retail spending, is clearly at historic low levels, 3.9%. But there's an expectation that it's not going to get out of control. The RBA expects it to be 4.25% in 2025. And I think if you look at wage growth, that's been pretty steady. Actually, what we've seen with wage growth is it's now started to flip over CPI, which means that in real terms, wages are starting to move back up again. And that's the first time we've been in positive real growth territory for wages since March 2021. Again, a very positive signal. As you can see from the share price chart on the right-hand side, the average movement in our universe was plus 14% over the course of February, which I don't remember it ever having been quite that strong. Obviously driven by a couple of real outliers. Step one I particularly call out, as well as Lovisa. But to give you a little bit of extra context about what the company has actually said and how it compared to our expectations, I will hand over to Emily.
First point to make is about earnings in the first half is that they were always going to be down year on year due to the interplay of elevated cost inflation with the subdued consumer spending. So, of course, this was the case, but the decline was less than we and the market had expected. So on aggregate, the EBIT of our universe of stocks was down 9%, with a median decline at the stock level of 8%. And as you can see from the waterfall chart on the left, this was mainly a function of higher operating costs, marked here as CODB or cost of doing business, which cancelled out the positive effect of sales and gross margin improvement. In EBIT terms, the strongest growth by far was from step one, which was up 40% year on year. And this was driven by the operating leverage effect of increased website traffic and average order value on a relatively small fixed cost base. Lovisa was next with 16% EBIT growth, driven by expansion of its global network. And then both BRG Group and Universal Store grew EBIT by 8%, both reflecting a marked improvement in gross margins. The biggest EBIT declines in percentage terms were from Accent, which was down 21%, JB Hi-Fi down 19%, and The Reject Shop down 16%. The primary reason for the decline in The Reject Shop's earnings was the large jump in the rate of shrinkage, otherwise known as shoplifting, excluding which the EBIT was actually up 3%. Accent and JB Hi-Fi's earnings were pushed down by the leverage effect of negative like-for-likes and, in the case of Accent, weaker wholesale sales. The dividend payout ratios increased by 20 basis points, led by particularly large increases from Lovisa and Beacon Lighting. how earnings compared with our expectations. So overall, EBIT performance of our universe was better than we expected, with a median beat of 3.2%. This was due mainly to higher operating margins as sales were broadly in line with our expectations. This, in turn, was usually a function of higher gross margins. So the three positive earnings surprises were Adairs, Lovisa, and JB Hi-Fi. And then on the flip side, Domino's was the biggest disappointment of reporting season. They say timing is everything, and the first half was supposed to be the result that demonstrated the beginnings of Domino's success in overcoming its pricing missteps and getting store sales back into growth in some of its problem markets like Japan. This has taken longer than we expected, and this caused an EBIT to come in 8% below our forecast. The shares were punished as a result. I'll just pass back to Alex to talk about some of the themes and our key picks.
I guess the first common theme that came out of reporting season was that most companies did manage to grow their sales positively, despite the fact that we're all in a subdued environment. In fact, every single one of the companies that we cover described the trading environment as challenging. And yet we did see positive growth. And that was largely because sales prices were higher. That's the other consequence of inflation. But also there was a degree of pricing discipline. And of course, some expansion in people's networks. The standout, again, was step one, growing sales by 26%, which was a consequence of getting the marketing message right for a change, putting in some better pricing structures, and also introducing some new products, particularly for women. The second theme I pull out would be gross margins. Em mentioned it a couple of times, but they were genuinely better than we expected them to be. I think a lot of it is to do with lower costs of inbound freight, which is not a surprise. But that better discipline around pricing was something that did surprise us quite a lot, because we heard a lot about how promotional the environment was. But it seems that if you have a bit of market strength and a bit of differentiation, you were able to shy away from the really deep discounts that we did see popping up across the sector, particularly in Black Friday. A third theme was that operating cost inflation was ubiquitous, inescapable. There wasn't much you could do about the fact that wages were going up the way they did, 5.75% in the minimum wage under the Retail Award, another 0.5% for the superannuation guarantee. So every company that we cover was looking at least 6% wage inflation on a like-for-like basis, and it's their biggest cost. If you're a bricks and mortar retailer, it's all about the people. And so that was a lot to absorb, and that's really the reason we saw that earnings were down. Retailers did consistently reduce their inventory balance. Now, this was a consequence really of coming out of the immediate post-COVID environment where we were all concerned about supply chain disruption, and a lot of retailers had buffer stock to protect against the risk of not having enough stock to sell. E-commerce is also getting back to normal after COVID. Clearly, we had a big surge in online shopping over the course of the pandemic, as people were sitting at home with not much else to do. But that really had a backlash effect when the stores opened. E-commerce really collapsed. We're now back in growth, and the penetration of online sales as a proportion of the sales of our universe is now moving back up. And finally, the appetite for store rollout appears undiminished. So despite the fact that we've all been beating ourselves up about the subdued consumer environment, a lot of companies have been taking the advantage perhaps of more space coming up to really accelerate their store rollout program. Beacon is a particular example of this, as is Universal Store, who opened a lot more stores in the first half of 24 than they did in the full year of 23. Accent continues to defy all sort of gravity in terms of the number of stores that it's prepared to open. And of course, Lovisa, despite having a relatively quiet period by their standards, continued to open into new countries, the last one being Ireland, and into many, many new store locations. How we play the sector now. So at the start of the presentation, I talked about the macroeconomic conditions being favorable for recovery in consumer sentiment. And there has been historically a correlation between consumer sentiment and share prices in this space, which is not going to come as any surprise. So there is an argument that the rising tide will float all boats here. But that isn't an investment strategy that we think is particularly good for the long term. And so what we're looking for is companies that have a significant quality overlay. So we'll look at businesses with a high return on equity, long-term growth, both in the rearview mirror and in terms of their potential for the future, a strong balance sheet that can facilitate that growth, a real, genuine, sustainable competitive advantage, and of course, a competent and experienced management team. And the companies that we think come through that filter the best at the moment are Beacon Lighting, Lovisa, and Universal Store. So thank you for your patience. It's been quite a long delivery. It's an even longer note if you open it, 26 pages. And what we've ran through is the reasons that we think the macroeconomic environment is looking more favorable for discretionary retail. We touched on the fact that earnings were better than expected over the course of February, and that we have upgraded our EPS by an average of 2%. And of course, we circled back with identifying our 3 key picks that we think you can buy for the long term, being Beacon, Lovisa, and Universal Store. Thanks very much.